So good afternoon, everyone, and thanks for joining us. I hope that you're all safe and healthy in this very bizarre period that we currently face ourselves in. And thanks to those of you joining. This is the 8th property webinar hosted by Rainmaker Marketing. And those of you who haven't joined or been part of these discussions, my name is Stefan Botha, and I'll be facilitating a discussion with our panel today. We want to keep today very different to the webinars we've done in the past, where we're really only focusing on questions from our last session, which was how to make property investing more achievable. So today's the follow-up. And just to paint the picture of how we got here, we had that discussion on the 18th of June, which had, in the end, over 5,500 people who viewed that specific webinar. And the reality is there were so many questions that came from it, so many questions that we didn't get to answer during the session, and so many questions that have come since then in terms of via emails, via messages, etc. And we just felt 1 hour at the time wasn't enough, and we really wanted to unpack it a little bit further. And just to recap some of the stuff we discussed, one of the big things was the knowledge gap. I really felt that there's a massive knowledge gap that exists in this country, which hinders the ability for more South Africans to own property, and really about how we were going to unlock that, or how one could unlock that. Then we spoke about the financial support that's available to buyers, whether it be government subsidies like FLISP, or how to secure a home loan through a bank. And that's obviously something that Simi and Tim spoke in depth about. And there were a lot of questions, I think, around how does one really get more out of FLISP? How does one go about getting a bond? And then the biggest thing was, how does the private and the public sector work closer together to help create more opportunities for more South Africans? And I think in terms of, obviously, Rob from IHS perspective, and Bongani from a Tonga Hewlett perspective, and Vuyiswa almost plays a role in linking all the parties. Some really good discussions that came from that. So in a nutshell, we said that if these discussions can help stimulate action that result in enabling more South Africans to have the ability to own property, then we're achieving something. And that in turn would create this ripple effect through the entire economy and through the entire property market. And I think we were obviously highly encouraged by what came about it. So today is all about the questions. There was quite interesting how diverse the questions were. So there were a lot of people who wanted to get into the property market. There were developers who wanted to understand how could they work more with government, but also with other developers in terms of facilitating opportunities. And then naturally, people who want to go into make a business out of property. And there's quite a variety around that. So we're going to try and get through all the questions. We're not going to be able to get through all of it, but we are going to hope that the discussion will bounce around to end up covering a lot of the aspects that people had asked for. So please ask that those of you who have the ability to go into the chat function at the bottom, or the Q&A function, and post any questions that you want. We want to try and keep it as interactive as possible, and we're not going to be going for more than an hour. So just to introduce the panel, just again, for those of you who weren't part of the last session, Vuyiswa Mutshekwane, who's the CEO of the South African Institute of Black Property Practitioners. Then Rob Westerlo, who's the Managing Director of International Housing Solutions. Euphonic, I know he had to pop off to do something. So if Euphonic joins us during the session, then obviously we'll introduce him. But if he doesn't, we're just going to direct his questions onto anyone else in the panel. Then Simi Naka, who's the Department of Human Settlements. So she works for Department of Human Settlements in terms of managing the subsidy administration and FLISP. Then Tim Akinnusi, who's the CEO and co-founder of Mortgage Market. And then Bongani Gumede, who I think has just popped off, who's the Managing Director of Tonga Hewlett Property. So I'm sure Bongani will be back on in a second in time for some of the questions that come his way. So I think just to jump straight into the questions, and some have been posted anonymously and some linked to names. But I think the first question, it's a really, really good, relevant question, and links to so much we spoke about in the last session, is from anonymous, and it says, how do we get the conversation on property ownership normalized at home? How do we bring it up and make our families know that we're not just dreamers and that it's possible? Vuyiswa, I'm maybe just going to push that one onto you and just get your thoughts on that.
Yeah, that's such an excellent question. And, just coming from the space that we work in the transformation space, and, a lot of the work that we do is very much just about encountering a lot of people, particularly African people, who have never had any contact even with the concept of property ownership from a basic family level. And indeed, it is an absolute priority to get those conversations going. But I think just I suppose to answer the question, I think that the key thing is to just start. I reflect on my own experience and, starting to get those conversations going in my own home. Fortunately, my mother owns a house, but, for example, she hadn't really necessarily understood, why is the concept of a bond and how one can, perhaps even draw from the bond to fund other important activities or to fund improvements on the house. In our families, it's a lot more, you just see a bond as a big debt and everybody's just trying to pay the debt off and it's like this burden on your back. So a lot of the conversations that I've been having with my own parents and with my family are really about understanding, a mortgage even as a debt instrument and how it can be used to advance us. And I think that's a conversation that has been very welcomed. So I think the key thing is really about instigating those conversations. Those of us who have access to that information or who are interested in those topics, we actually have a responsibility to bring those conversations up and to teach everybody in our families and in our communities about property and about how we can actually leverage property to our benefit. I mean, just sort of lastly on that topic, we also have a family home in a township area, which was my grandmother's old home, and I think for many people who live in townships or who have perhaps inherited township homes, they may be living in houses and not recognizing that they are actually living in a financial asset that can be used, that can be bonded, for example, and can be used to actually, lend against, obviously not for something risky, but where there's good reason to potentially draw from that. And I think, it's also drawing that connection between the roof over our heads and bridging that gap to the financial industry. And that's a piece of education that I think is certainly missing from many of our communities. And I hope that those who have that know-how are actually instigating those conversations and having them around the table.
Yeah.
And then,
I mean, Vuyiswa, just as you've said, it's about everybody who is in a position to instigate those opportunities. If I had to look at the schooling system, and I'm going to divert slightly here, it's about this concept of, we never get taught why money is important at school. We never get taught about the value of money, what money does, and that is also linked to something like property, where we don't get this really fundamental basic education about what property does and how communities develop, how cities develop. It starts with a grouping of people in homes, and I think, hopefully with a time such as now with COVID, where the home has been just about everything to us, it's been our place of business, a place to socialize, catch up with friends, we have Zoom parties, et cetera. I mean, that should really spark the idea that, hey, we're sitting on something that has high utility here. And it's best to get into a position where, kids start to understand that and young adults start to understand that. I mean, I'm considered a so-called educated person. When I started working in Joburg, the first thing that I did with my paycheck was to buy a car, right? So I bought a car and soaked up about 50% of my income with paying off this car. Then I saw a place out in Sunninghill that was going for 350,000. It was a townhouse apartment. I chose to party on the Saturday and then go and have a look on the Sunday. It was all sold out. The next phase was at 379. And all of a sudden, that 30,000 Rand odd meant I couldn't even get into my first house. And so many youngsters are going through that same process time and time and again, acquiring debt that, is not particularly value adding. And then missing out on actually acquiring debt, that is value adding, such as property. So, yeah.
If I can just add to that, Stefan, is that, it can be a very scary thing, as Vuyiswa said. The idea of having hundreds of thousands of debt, and I would agree with you, Tim, that the difference between debt, which I prefer to call leverage on a home, or even a house that you don't live in but that you rent out, versus debt on a car. And I have this conversation often with younger people in my office, because I remember those days just like you wanted to buy this awesome car for whatever reason, and it's the biggest waste of money. So honestly, for young people that are listening or watching, avoid the car. You can save yourself so much money over a long period of time by rather using the leverage to invest in a property. And it can be scary. It can be scary because it's a big number. But the beauty about property, and one of the most amazing things about the asset class, is that you can leverage it. And we're at a point in our interest rate cycle that we've honestly never seen before, even old people like me. It's I think we had about a 50-year low, 7% prime rate. When I was in my early 30s and trying to invest in property, interest rates were 25%. So, and I still did it. It didn't always work, but to have interest rates of 7%, to be able to gear an asset that is going to grow over time. We're not in the best market that we've ever been in, but property values are still growing. And the benefit of the leverage is that, one of the questions that was asked that we'll probably get to at some stage is, if I have 300,000 rands worth of cash, should I invest it in property? I'm a property bull, so I think over the long term, yes, you should, but I don't think you should invest cash. You should use the benefit of leverage. Instead of buying one property for 300,000 rand, buy 4 properties of 400,000 rand each and gear them. If you can do that, it's not as simple as that. But if you have the opportunity, you don't need to start big. You could even form investment clubs and start with other members of your family or close friends, and buy together. It's similar in the equities market. Buying equities sounds like a very scary, difficult thing if you haven't been there. But if you just start, even if you start very, very small, and you buy 5 different shares, and just even if it's one of each, you start to look and you start to watch the market and learn about it. And it's the same with property. You can start small. You can start in a club of sorts if you need to. But once you're in the market, you really gain a lot of knowledge. And there are many people that you can talk to that can advise you on how to go about that.
And I think it's just to add to that, is that, Tim, I know you spoke on SABC News about it the other day, but when interest rates are as low as they are, it's great for people who are lending money, but it's not great for people who are sitting with their savings, sitting in an interest-bearing account or call account or savings account at the bank. So it goes to what you guys are saying, and it can be perceived as risky, but there's so many people in the same boat. But now is a better time than ever for people to be utilizing that money slightly better to, like you say, leverage a bit and put down so you can see greater growth.
100%.
And then I think it goes to that exact question we've had now, and someone's going to put it to you again, but it's from Nzambalala Sapuma, and it just says, I agree with the view that there's been less transformation and ownership of a movable rather than movables, i.e. cars. Do you perhaps think that there might be some gatekeeping that slows down the progress when it comes to ownership of the movables by people of color? I know it has been addressed a little bit, but if you maybe just your input there.
Look, I think, and if I may speak candidly, I think the reality is that mortgages make the banks a lot of money. And banks are in the business of charging, they're in the business of charging for the use of their money. So, a bank will always want to secure a mortgage with you, and ideally for as long as possible. But that does not mean that you cannot pay your mortgage off faster. And there have been many people who have, taken the 20-year loan and understood that just because it is a 20-year loan doesn't mean I have to wait 20 years to pay it off. And, even something as small as putting in, 100 Rand, 500 Rand extra into your bond every month can significantly reduce that period. So certainly, I will say it unequivocally, banks are not in the business of charity, and they're not in the business of social development. Those are NGOs like the one that I work for. We are in the business of social development. Banks are in the business of profit. And you can decide as a customer whether you want to be a source of maximum profit for the bank, or if you want to use this vehicle that the bank has given you, i.e. the leverage, to actually advance and improve yourself. And by paying in just that little bit extra, and I think Rob said something so critical earlier in terms of starting small. You know, a lot of us have and we all do it. We have a tendency to go and we do that check to see how much we're worth or how much we can afford, the affordability calculator things. And then we find out that, oh, fabulous, I can afford a 2.5 million rand house. Perfect, I go and buy a 2.5 million rand house. Actually, that's really not necessarily the way to start. If you can afford a 2.5 million rand house, you buy the one for 1.5 or the one that leaves you a little bit extra breathing room. Then you get a smaller bond and you put more into it, which allows you to pay less interest on the initial capital over time. And you actually are then able to take control of this vehicle. So I will always say, you know, banks are going to do what banks do, but the nice thing about banks is they are predictable. You know what they're going to do. Now the difference is, what are you going to do now that you know what they're going to do?
Stefan, if I can just sort of jump in here, you know, okay, so, you know, Vuyiswa makes a really good point in as far as talking about banks being predictable and you know, what their agenda is. Yes, they have a very commercially minded agenda, but that agenda is not just simply about making money. It's also about providing liquidity and credit to help speed up the rate of development, help speed up the rate of accessibility that customers get towards getting, you know, bond finance or a car loan or credit card, et cetera, et cetera. Liquidity and this credit is what makes the economy tick over, is what brings in transactions, right? So the point I want to make here exactly is that as much as the banks, you know, do give you a mortgage over a 20-year period of 25 to 30 years, right? That is about helping you be able to make affordable repayments back on the mortgage, right? Because in many instances, it's not to say that they aren't in a position to simply say, we can only give you this for over 5 years. Over 5 years, you would not be able to afford the monthly repayments on a million rand house. But over 20 to 30 years, that then makes it more accessible for everybody to be able to get into it. The most important thing, which is to your point, Vuyiswa, about what are you going to do about it, is customers or anyone taking out a mortgage, they need to understand that they have every right to pay that debt off whenever they want to. And they should understand also the instruments as to how to go about doing that. You know, if you put in just as much as 15% more than your contractual payment back into your home loan, guess what? You can pay it off in 6.5 years. Now, that information needs to be disseminated out and circulated more and more and more, right? Because, you know, in fact, all banks have a requirement to show you exactly how much interest is being charged over the life of that entire bond, right? And you can choose to be able to suppress the interest charges simply by paying it off as quickly as you can when you get into a position where you can pay more. The question is that not everybody has the opportunity to pay more into it, you know, and hence we have this issue of, you know, individuals feeling like this is a debt burden over their heads over a long period of time. So it's kind of it's a give and a take, you know. The banks make it accessible to you. It's important that you then understand how to make it work for you, basically. Yeah. And I mean, just this topic alone, I mean, we can have a whole discussion about it, but
absolutely,
it is possible. Yeah.
Stefan, if I could just jump in there, I think, you know, I definitely hear what Tim's saying and Vuyo in terms of what the bank's priorities are. But remember, I mean, when you're talking about individuals and you say it's, you know, you have the power to look at the interest rate, look at the period, pay in more money. Like you say, we all, you know, people would take out the max and buy that property that they qualify or pre-qualify for. So they won't really have that extra to put in. And if they do get the bonus, etc., won't necessarily think of or might need it for something else. But my issue, and I think from just a government perspective, or just looking out for the public and our beneficiaries, first beneficiaries especially, is that the interest rates. Tim, when you go in, or Rob goes in for a loan or a mortgage bond, the interest rate you get would be far more preferential and lower than what my first beneficiary would get, because they're a higher risk. And I think if across the board they could have the same interest rate across the board, or don't already add to the person's risk, or his he's going to have a sale and execution or default, etc., simply because you're loading him with that interest. If you're paying 7, I should pay 7, my first beneficiary should pay 7%. It's not a case of you're a higher risk. I've seen some people being charged 15, 16%, before all of this, the interest rates drop. It's because they're considered a higher risk. There is disparity there. And I think that's where the person asking the question, I think they're looking at it that way in terms of these kind of gates to entry. Yes, sure, you're a high risk, but let's help you more. Let's not make it harder.
To me, I think that's such an important point to make, and one that I'm also quite certainly passionate about, which is, those sort of invisible barriers to entry. And everybody knows, who's ever sort of sat in front of a credit committee, or who's ever had to have a credit application approved, that we do live in a society where certain identifiers or certain characteristics, be it your residential location, be it sometimes your age, be it your race, be it whatever it may be. I once found out actually that the mere fact that I changed my cell phone number many times was, perceived as high risk. So it raised actually my risk rating with the bank, because my cell phone number changed, 4 or 5 times. Probably in hindsight, I was quite risky, but that's not the point. The point is that, we do have a lot of those kind of, there certainly is a disconnect between how many of the kind of more established commercial banks would assess somebody who's coming from a non-traditional, call it even township, call it even rural background, somebody who perhaps is even a freelancer who doesn't have a stable income. We've got a lot of people now who are part of the so-called gig economy, who are just not factored in to the current risk rating system. And certainly there's a lot of work to be done by the banks and the financial institutions in terms of making sense of this new demographic of people that are coming into the market. But with that said, I must say it is encouraging, and I've seen some of the recent stats where the highest growth group in the property market over the last 10 years has been amongst Black African people, and particularly one of the highest growing groups is amongst African women. So that's also very encouraging to see. And I certainly think, conversations like this and just talking more about property, making it more accessible, demystifying it, is one of the things that really gets people interested and gets people actually even able to imagine themselves as property owners and going down that road.
Vuyiswa, if I can actually add to that point, because I think it's a very good point, to take it to the next level, because I would imagine that in the audience today, we've got a lot of people that are thinking of home ownership versus property investment versus development. So similarly, if a developer with very little track record or experience goes to a bank to raise capital to do a property development, those barriers are there as well. So, those of you that have sat in credit committees at banks, it's often quite difficult to get through the door for the first time. Where's your track record? I don't have a track record. Okay, we can't lend you money. Okay, so then I can't get a track record. No, so that's a bridge you kind of have to cross. And we're very proud at RHS that we've managed to partner with some of those people over the last 10, 12 years that couldn't get that first opportunity because they needed the equity backing. And some of those companies have now grown into into much bigger companies that, frankly don't need us anymore, which is kind of what we set out to achieve. So that is also a barrier, and that's a supply barrier. The one other important differentiation that I think we need to continually make is between buying a home to live in and buying a home as a pure investment. And the gearing, again, can be very, very useful. If you're spending 100 Rand on a house and people say to you, well, the property market's only growing at 3.5%, so your return's only 3.5%, that's not true, because if you're gearing that property 90%, your return is on 10 Rand, not on 100 Rand. If you're buying equities, you're spending the whole 100 on the equities, and who knows what your return might be. You might go negative 20%, you might go positive 10%, but from a return on equity point of view, you're still doing better on the property. And again, sometimes it's useful to do that in groups. It could be a family, it could be close friends. It's a very useful way to look at it.
Okay, and then Tim, just a quick question. I know it was actually one question that had come through before. So, and it comes across in everything we talk about here to the credit score. I know Rob was talking about the demand side or the supply side. And in terms of the demand side, your end user, you mentioned last time that second to your ID number, your credit score is the most important thing to your next to name. How do you build up that track record, like Rob said, if you're an end user? But secondly, if you don't have a good track record, what are the best things guys can do to try and get that credit score back on track?
Yeah, so the issue around credit score is that it really is about how the banks use an objective instrument to judge the quality of customer that you are, or quality of borrower that you are, right? So, and all they're trying to understand about that is to look at how you have conducted your relationship with credit in the past. So hence they much rather you prefer that you have actually taken out credit before on smaller items, like a cell phone contract, right? We all know cell phone contracts are like a dime a dozen. Everybody's got a cell phone contract. So the banks will look at that as a lead indicator to say, how well do you pay your cell phone contracts? If you are somebody who is not able to make consistent repayments in a cell phone contract, then how can we trust you with R1 million? How can we trust you with a much larger credit facility, right? So it's really about saying they want to be able to track the level of predictability for you to repay them back. And that's what really goes into your credit score. The second part about that is also the nature of the credit that you are taking out. If you say you're someone who, for example, makes, say, 50,000 Rand a month, and what they're seeing is that your credit exposure on your credit card is another 100,000, and you have 3 personal loans, each totaling 200,000. As much as you may not actually be defaulting on any of these credit lines, they will see that as a trend where you're relying too heavily on borrowed credit to fund your lifestyle. That will impact negatively on your credit score, right? So it's not even to suggest that the banks want you to go out and take a whole bunch of credit before you can get a credit score, but is they need certain things that are reasonable to be able to predict. And then also they start looking at the nature of the credit that you are taking out. And the reason why I say it's such an important time for you to pay attention to it now is we know incomes are under pressure given the current environment, right? We know that people's jobs are being obliterated. We know that people's jobs have been halved, etc. Sorry, rather their incomes, right? So you need to protect yourself now by continually to make consistent repayments on everything that you owe debt on, because we're going to ride out this time. And what you don't want to find yourself is in a position where things normalize and you do need the credit facility, and the banks look at your track record and say, hang on, we don't think that you're worth bonding, right? So we see thousands of customers doing pre-approvals on our platform. Customers whose profiles are really great. But guess what? 2 years prior to that, they had incidents where they had defaulted on a credit payment. And right now, what the banks are now looking at is saying, actually, in a time like this, where we know that the economy is in a recession, can I trust you to make consistent repayments, right? And it's not just about being able to borrow you the money, it's also about making sure that you don't destroy other assets out there by them giving you the money to buy property that ultimately could get repossessed and could get sold at a much lesser price than its trading value. And that then means that you start to see a decline in that particular area because house prices are then, going down. So it's an important number, and each one of us need to understand exactly where we stand with credit. It's a good habit. If you want to be able to do well with money, you have to start to get familiar with it. There's just no two ways around it.
There's a comment that's come through from Norma Mazabuka, which is a very relevant one. I'm sure a lot of people on this who are watching are thinking. It says, are any of the members of the panel willing to mentor anyone who would like to get into the property investment space? I'm not going to put anyone on the spot right now, but it's such a valid point. Like, how does one create more ongoing mentorship for people exactly like Norma who want to know more about investing in property?
Yeah, there's definitely an imbalance in terms of the supply and demand factor when it comes to mentorship, coaching, etc., etc. But what I would encourage is, I think a lot of people have a tendency of actually becoming debilitated by the idea of mentorship in many ways. Like, I can't move because I don't have a mentor. I actually can't do anything because I don't have a mentor. So absolutely, I would say that where it's possible, try and seek out counsel from people who know more. But that it doesn't necessarily mean you have to have one person who you kind of meet with on a regular schedule, etc., etc. Usually, the people you want to be mentored by are not actually able to commit to that type of a relationship. So I believe that, and I speak for myself here, that when people have said to me, who are your mentors? I don't have mentors. I make sure that I kind of, when I see someone who I think knows what they're talking about, I ask them relevant questions. I store everything they have to say to me. And if I never see them again, that's fine. I've got what I needed to get in that particular kind of encounter. And I try and sort of do as much research as possible and surround myself with as many people as possible that can help me. And I'm a firm believer in that whole sort of power of 5 thing. They say you are as good as the 5 people that you surround yourself with. So I'm very big on kind of making sure that I build relationships with people who are on the same journey that I'm on, which I find can actually be more valuable than the so-called mentor-mentee relationship, because sometimes those can be a bit empty, But yeah, I'm saying definitely, where even myself, I mentor a lot of people unofficially, not really necessarily like we've got a mentorship agreement or any such thing in place, but those who want to ask me questions, if I'm available, I'm happy to answer any questions or assist where I can. And if I can't, I pass them on and say, maybe somebody else would be better to do that. Yeah.
Perfect.
I really like that approach to mentorship for you, so it makes a lot of sense to me.
Yeah. I think just another point to add. I think the more I also listen to the panelists, I think for me one of the key issues is that a lot of barriers that we experience are actually self-imposed. I think it was Arthur Ashe who said, if you want to progress in life, you need to start where you are with what you have and do the best you can. And oftentimes we set the bar higher than we can jump over, and that in itself becomes our own barriers. So to the extent that you actually realize that first, in this investment and economic market, you are a brand, and your credibility that you build is what others will invest in. So don't look at financial investment before you actually have built your own self-discipline in investing whatever you have, wherever you can invest, and show track record that you can build, you can trust yourself with your own money and your own assets. So I think the first part really is about building self-credibility and sustaining that with discipline, and using what you have and starting at those levels. Because if you rush to start at levels that you can't afford, then the barriers will start to emerge. Then the problem is the bank that sees me as a higher risk. But actually, have you evaluated your level of affordability, your level of ability to sustain yourself with what you have before you can actually go borrow something from someone else?
Can I add something onto that, which is not exactly what you were talking about, but we're in a amazing market at the moment, which is quite lopsided, and it's lopsided towards the more affordable market. So the truth of the matter is you're going to do better out of an investment, to Bongani's point, if you, and like I said earlier, if you start small, start in a cheaper environment, there's much more demand in the cheaper environment because of the nature of the society that we live in. There's way more demand in the more affordable space. As a result of that, if you look at the market over the last 1, 3, 5, and 10 years, the big hit has been in the expensive market. So, if you've gone out and bought the $2.5 million house because you could afford it, it's quite likely today that it might be worth a little bit less than $2.5 million. On the flip side of that, if you bought a $400,000 or $600,000 house or apartment, it's quite likely now that there's been some decent capital because that's where the growth has been. And if you are in the market for renting that house or apartment out, the demand for rental is in the affordable space. It's not in the 25,000 Rand a month market. It's in the 3, 4, 5, 6, 7,000 Rand a month. That's where there's real demand. So it makes sense to start in the more affordable space, economic sense in the current environment.
Yeah, Rob, just to add to that, Stefan, is I think part of the education is also about understanding the value drivers of property. I think that is something that is often misunderstood. So one of the factors that would always hamper high-end homes is the level of customization that happens in a high-end home, right? So if you buy a house for 5 million, that individual has customized it or has potentially overcapitalized on aspects of that house that do not necessarily produce economic value. Let me give an example. If you own a 10 million Rand house, or you are looking at a 10 million Rand investment house, you'll often find that the house has an Olympic-sized swimming pool or something ridiculous that the next person that comes along is unlikely to see value in, right? So he would ask himself, why would I put a premium on that particular sort of feature, right? But money has been spent on that. Versus a house in the affordable housing space where there's a lot of standardization, there is a lot of, in fact, everything about the house is economically useful, right? And that's why you'll often find that the price in the affordable space in middle markets is far more resilient than, let's say, the 10 million Rand house in a Houghton or somewhere else. You would just find that it's just really difficult to find a large pool of buyers who are likely to see the same value in it.
So Tim, you're trying to tell me that I should have spent a lot less on my bar.
No, I think everyone sees value in a bar, right?
You have a bar, we will be there.
Yeah, depends what's in it.
Rob, so you mentioned that 300,000 Rand earlier, and it's actually Nia Lesako and Saneli Machalia have both actually asked questions since then. Saneli is talking about 400,000 Rand that he saved up, and Nay is talking about 500,000 Rand that he saved up. I'd love to learn. That sounds like a great position to be in. But I think the question here is, what would you do in that position? Would you be buying off plan? Would you buy an existing property? Would you be looking at stock for rental? I know you touched on it, but it is a really, really good question. What would be the first thing that you'd look for?
So, I think the truth of the matter is that I would be looking to buy in the affordable space, and affordable where there's high demand, in the current market, I would see in the space between 400,000 and 800,000 Rand per opportunity. I think if you're buying in that space, you're going to be renting in a market where you're asking, 4,000 to 8,000 Rand a month. Somewhere around there, we've seen that's a defensive market, it's a very popular market. I wouldn't be putting that cash into a home. I'd be getting whatever gearing I could get from the bank, and maybe buy 2 or 3 properties and cross-collateralize them. It'll help a little bit from a risk point of view with the bank. I know that everybody can't always carry the cash flow, but because you could be in a situation where your bond repayments are slightly higher than the rental income and the associated costs that go with that rental income. Fortunately, in a very, very low interest rate environment that we're in now, that may very well not be the case. But if you can carry a little bit of negative cash flow, what works very well is that you are able, with your tax returns at the end of the year, to claim back your interest costs to the extent, and let me use a very simple example. Let's just say that I rent out a property and I earn 15,000 Rand a month income. I'm gonna make it a year just for the maths to be simple. Not my strong point. Let's say I earn 15,000 Rand rental in a year from a property, but my costs for holding that property over a year are 18,000 Rand. So clearly the first thing you need to be able to do is to be able to carry that negative cash flow. But if you can, at the end of the year, when you do your tax return, you can actually claim that negative cash flow back from the taxman. So it's an incentive to save, it's an incentive to build, and the costs that make up that amount are not your capital repayment, but your interest costs, your rates and taxes, your levies, your collection commission, all of that forms part of a cost base that if you have a negative carry, you can claim back from the taxman. And I appreciate that not everybody is in a position to be able to carry that negative cost. So it's important that you don't overgear yourself. Even if gearing is a very, very good instrument, you've got to be able to carry the cash flow. Otherwise, to Tim's point, you get yourself into a situation where you start racking up a bad credit record. And I completely agree that, people need to be thinking about their credit record long before they are asking anybody to lend them money, because if you wait, it's too late. If you are in a position where you're able to spread that 300 or 400,000 Rand around between 2 or 3 properties, and you're able to gear 2 or 3 properties, I would say that over time, we're not in a market now where you can buy today and sell in a year's time and expect to make a fortune of money, because the costs associated with buying and selling are there. But I know that if you buy property and you keep it, and you don't sell your good investment to buy a bad investment that could be a car, could be anything else, over a period of time, you're going to do well and you're going to retire happy. If you buy property and you keep it, you're going to do well over a period of time. Whether you buy a new property or you buy an existing property is probably, speaking against my own book at the moment, you're going to see a lot of opportunity in the existing market. The price per square meter is probably going to be a lot lower. But the alternative side is, new properties, particularly the smaller new properties that are getting built at the moment, are a lot more efficient. They have a lot less maintenance. There's a lot of effort being put into lowering electricity costs, lowering water usage, and the like. And that can be very important when calculating the total cost of running your property.
I think it's spot on there, Robert. And Johanna Mutshekwane, I hope that answers your question. So I think it spoke to also in terms of tax write-offs. I think just one thing to add to what Rob said, there's additional security to taking a bond, in the sense that banks are obviously effectively taking ownership of their property on your behalf. So they've got certain checks and that they need to be fulfilled by a developer or by a homeowner. So you've got protection on that side too. And I think another big thing Vuyiswa spoke about earlier is the barriers to entry. Is you're seeing a lot of developers, especially with off-plan properties, bringing down those barriers to entries, not necessarily focusing on a 10% deposit like they did in the past, bringing those deposit amounts to 10,000 Rand or 20,000 Rand in some instances. subject to you getting a bond for the balance, which helps a huge amount in terms of not having to fork out 300,000 Rand to purchase a property. And I think those are all factors you've definitely got to take into consideration when looking for what you're investing in. And Bongani, I just want to bring you in here because this is a question, was an anonymous question that came through in the week leading up to this. But we've spoken so much about the link between public and private sector. I mean, I know a lot of developers in the last little while have been talking about the shortage of homes. I know the guys from Amdec, for example, spoke to the course this week about how in the Western Cape alone, there's a shortage of 300,000 homes that need to be serviced. So I think the question here just said, Bongani, what is the one key thing that you think government needs to be doing better in order to help stimulate development via private developers who want to unlock well-positioned housing opportunities?
Yeah, thanks. I think it's quite a good question. And we battle with this question all the time ourselves as a land developer. Just to first position Tonga Tulet in the development value chain is that we do township establishment. We plan the township, we bring in the services, and in bringing in the services, we engage with the public sector to connect to the public network, etc. And oftentimes that triggers need for upgrades to various, public infrastructure. But a lot of that, we find that it's actually levied on us as the land developer, which then obviously we will pass on to the top structured developers like Rob that would approach us and looking for parcels of land to put up apartments, etc. But they also get additional costs put on them for drawings, for a number of parking bays, for generated traffic, even rates before even the first flat is occupied. So there is so much that public sector can do to actually lower those costs for us that in any case they would recover when the, call it the user pay, when the occupants of those buildings start paying rates, buying utilities from the authorities and increasing their revenue base. So the challenge is that by charging us upfront, public sector raises the cost of the purchaser because we are going to recover that cost from whoever is going to be the purchaser. And in that way, it actually cuts a significant number of people out of the affordability range just because of the cost of the upfront cost of these services.
Okay.
Thanks.
So Rob, I just want to ask you just to add to that question. So this morning there was an announcement. I'm sorry, I know this is one of my questions, but it links to that. So this morning there was an announcement by government to say that 340 billion has been committed to fund some of the 276 projects that the president referred to at the beginning of the year, and of which 62 of those are shovel ready, and it will unlock 290,000 potential jobs. So what they're saying here is that they are going to try and bring the zoning process down for those opportunities down to 56 days. Previously it would have been between 18 and 36 months. But then the question is why does it take something like that to unlock those the turnaround times when it comes to approvals on developments that will unlock jobs and opportunities? Is there not more that government can do to make it consistent across the board?
So, I mean, I hope those 56 days happen. I really, really do. But as you've seen before, it's easy to write the policy that doesn't necessarily translate into an actuality. And, to add on to what Bongani said, that would have been one of my big issues that I would have raised. What can government do? They can make the process quicker and easier. Completely agree that the servicing costs, and when you're in the affordable space, you would expect that there would be an acknowledgement that those types of infrastructure costs are a much more heavy burden on the affordable market than they are on the high-end market. And you find that whether you're building a house for 600,000 Rand or 6 million Rand, they have similar infrastructure costs, and you know, that should be addressed. You know, if you're building affordable housing and social housing, I mean, we're building social housing where our infrastructure costs are just unmanageable. And this is a problem not only when you're developing, but also when you're operating. So, you know, we have instances where for 55 square meter apartments, our refuse cost is the same as a house in Houghton. You know, I mean, it just doesn't make sense. And, you know, where you're trying to charge someone as low rent as possible, you know, you're charging them, you know, 4,000, 5,000, 6,000 Rand a month in rental, and you get a sewer cost of, you know, 400 or 500 Rand a month. It's a real big issue. So I really hope that those shovel-ready projects get delivered in 56 days. Municipal capacity is an issue, not in every local authority, but it's a big issue. So, you know, even without, you know, funneling a whole lot of projects through a policy process, it's quite tough to get turnaround time. So I think that'll be a challenge. You know, I think government could probably spend more time speaking to the private sector and even getting the private sector on board. Yeah, in most cases, you know, we'd all be willing to assist and to get involved, particularly in the affordable housing space. You know, I think that infrastructure costs and the time that it takes to turn things around, it's too big a percentage of the cost of an affordable house. And, you know, there's no legislation that says that for social housing, you get, you know, allowances. So, you know, if you're charging, in some instances, we're charging people, you know, 1,000 Rand a month for an apartment. It's a typical townhouse because of the SHA subsidy, which works very, very well. But you can't then, in that instance, be charging the same for a sewer connection or refuse collection as what you are in a, you know, 1 million or 5 million Rand house. It doesn't make sense. So I think there's a lot more, you know, the thinking is always good. You know, it's the implementation that we have to get right.
Yeah, Simi, yeah, and I want you to. There's a couple of questions I need to ask you too.
Yeah. Look, I can say, fortunately, I'm in provincial government, not local government, but no. What I would say is, with local government, all of these issues that you're raising with challenges with turnaround time, with connections, with fees and charges, etc. Yes, those are challenges, especially in affordable housing, where you've got projects for your FLIS buyers, your first-time home buyers, or social housing rental. But I think key always, and when we say what can government do better, or what can we do to assist, is always that interaction, that interface. Personally, in KZN, for the affordable housing as well as social housing, we are good with interacting with municipalities, going to the right people, saying to them, look, waive those fees or reduce those fees on this development, be it a private development or you know, something in joint PPP, as long as it's got to do with our beneficiaries, etc. But I think there's nothing stopping private developers interfacing, Tonga Hewlett or you know, Rob with IHS, interfacing with people and saying, look, this is a development for this affordable housing market, social housing. We need to have it waived because this is a huge demand. We're going to help you with your backlog, help you with the beneficiaries. So I think a lot of times people feel, okay, those are the red tape and the bureaucracy, etc. But there are ways and means to find, you know, better ways of doing things, and people are open to it. I think also in terms of what government can do, remember you've got those that add to the purchase price or your costs of development, top structure, infrastructure, but we come in with, from provincial government, from human settlements, we come in with the subsidy, the FLIS subsidy for first-time home buyers, used as a deposit, helps bring down the costs. Equally with social housing, there's so much in terms of subsidies available with your costs. It's almost, you know, like you're working from the provincial side and the local government side, but there are ways and means of balancing it. But I think as private sector, if you take the initiative and say, look, this is way more better to do, in terms of financing even, instead of bridge financing or getting your own bond, there are ways and means to approach. I think the question came up Stefan, on NHFC and funding.
Yeah.
We've got a DFI now, which is where Nurture, Rural Housing Fund, RHLF was there, loan fund, sorry, and then I think NHFC, RHLF, and Nurture. Yeah, sorry, there's one DFI, and they actually finance developments for affordable housing. There's the PIC GEPF cash injection for affordable housing developments. I'm just intricacies of it, but it's things that we can go back and check as developers or as investors. Lastly, there may be the Human Settlements Development Bank, or it is on the cards, maybe run by NHFC or initiated by them. That may have way better, financing options for developers and investors.
And I must just add, Simi, that IHS, we're a beneficiary. We've had the NHFC invest in our funds over time, and we have a great relationship with them, and it works very, very well. And it's been a great angle for them to ensure delivery of more affordable and social housing. So I would agree with you 100%.
And I know Tazama and Dima asked that exact same question: are there successful models? And I think hopefully that answers the question there.
Yeah.
Cindy, I just want to ask you. There was just a question in terms of Nameli Delormo, who said, "Please assist with clarity in the process of FLISP and how it can be streamlined so the product can align with the bond registration process with the various banks."
Okay. There's always the issue of because it's finance linked, all provinces, including NHFC, who does FLISP, so you've got to get an approved bond in place. In KZN, we kind of do it concurrent. So you apply for the bond, you get an approval in principle within a day to 5 days, etc. Once you have the approval in principle, you come to us. The team in KZN, we're proud to say we can approve you within 5 days. All your documents are in order, please. And we actually pay into the bank suspense account, which KZN has initiated. We said, look, open a suspense account. We'll pay the subsidy in there. And that, we're proud to say, is before the bond account is even registered or active. You get a bond account number, but it's not always active. So sometimes we were having monies just going and landing everywhere. So we said, open this dedicated account. Sits there until the bond registration. So I think people should know that FLISP is not something that takes long to process. Work with us, whatever province you're in, work with the team, get your documents in order. It can be fully aligned with your bond registration process to the extent that you can use it as a deposit, and have that paid out to the conveyancer, transferring attorney, or the developer, way before, you have to look for something or have cash in hand. Only thing is we don't pay for transfer fees or legal costs. Okay.
And I think that also answers Nameli Delormo's question, who basically said, how do you go about raising that deposit amount? And she used the amount of 200,000 rand. But I think, Nameli, I think that the good thing you can take out of this discussion today is that you could utilize FLISP to pay off your deposit. And in many cases, developers are allowing you to pay far less than that amount to secure your purchase with the deposit, which means that you, like Rob said, you have the ability to leverage that money as opposed to putting it all down.
Yeah. Stephen, just to add on that.
Sorry. No, it's fine. Go, sorry.
Just to add on that, it just also helps developers because, in terms of bridge financing, if you pull all of the FLISP buyers, the FLISP monies as deposits, it helps with that bridge financing, and it helps with, your situation as well as a developer. So we're hoping that also ends up helping the purchaser. So your prices come down, and, it must go around, hopefully. Sorry, Rhea.
No problem. I just, the question that Stefan was referring to about someone who was asking about how to kind of get that initial capital for one's first property investment. And it just triggers something that actually, Rob, you raised it earlier about savings clubs and investment clubs, stokvels and all of those types of vehicles. I mean, it's really an exciting time to see the evolution of stokvels and investment clubs, and a lot of them now are a lot more property focused. There's even apps and such that people can run these stockpiles through, like the Stockpiler app and others. But what I've seen is actually a lot of the property stockpiles, many of them, that's what they do. So a group of 5 or 6 people come together, and the money that they contribute, which is paid out on a rotational basis, is actually used then to put down a much more substantial deposit for a property. So, you know, I'm a big supporter of those types of vehicles and initiatives as well. And I think it's a really great way for people to just start where you are with the people that you know around you and that you trust. You know, there's now technology platforms that enable and make it safer for you to actually save collectively. But I think collective investment is about to take off in a really big way. And I think property is one of the safer things, you know, rather than just always saving for consumption related activities. It's really great to see people now using the stockpile model to save towards, you know, fixed investments and investments that appreciate over time, like property.
And then Vuyiswa, I was going to ask you one last question. There have been a lot of queries that have come through around alternative ways of purchasing. And I think you've chatted, you spoke about stockpiles, for example, which is one of the questions. Another one from Larata Maka said, what is your take on installment sale agreements through the Alienation of the Land Act?
Yeah, I mean, personally, and I don't purport to be any kind of like licensed advice giver, but I've heard a lot of different accounts, and I think the key thing there is one, to obviously make sure that you use you know, a lawyer, or actually get proper legal agreements drawn up between the buyer and the seller that can protect both the buyer and the seller. And I mean, for those who aren't familiar with installment sales, essentially it would be an agreement between a buyer and a seller to pay off a property in installments, similar to how you'd pay off a car or whatever, but perhaps, so maybe it could be a shorter period, let's say 5 years, and you agree to pay, you know, 200,000 a year for 5 years for R1 million property. I find usually that those also work better where there is some level of trust or personal relationship between the parties. So, you know, if you are buying a property, for example, from your business partner, or from a family member or a friend, but nonetheless, even with all of that in place, really it's all about making sure that the legal framework is very clear and that it's drawn up, and there are a number of attorneys that I'm aware of who do that. It's not an option for everybody because, again, the cash flow is always the issue. Not everybody is in a position to pay sort of 200,000 in a lump sum at a particular time, but certainly there are those people who are unable to go the traditional route, perhaps because they don't earn in a traditional manner. They aren't able to produce pay slips. Perhaps they once, you know, defaulted from a credit perspective, and they can't be accommodated in the banking system. And for those types of people, installment sales certainly presents another option. But again, just make sure you get your paperwork right.
But like you said, first point of call would be that if you do have the credit record and the ability to be able to pay monthly, that the traditional process of getting a bond would be the safer and probably the preferred route. Yeah.
Yeah, but as I said, I mean, I think they are, you know, we are entering the age of non-traditional earning methods, you know. Yeah. So if the bank is going to be dogmatic about the fact that it wants to see 3 months pay slips and this and that and that, those days are over. It's not the industrial age anymore. So those who are in the gig economy, for example, people who earn, you know, lump sums every 3 months, you know, the bank kind of cannot deal with those people. So, you know, it is going to, I think there's definitely going to be a lot of disruption in the financial sector as people look for options that are much more suitable and tailor-made to the realities of their lives, which is that, you know, I may have had a bit of a bad credit record at some point. Now I'm here, and I need a place to invest. And if the bank won't have me, somebody else will.
So again, it's very similar to last time. I feel like we've only just touched the tip of the iceberg. But I really do appreciate everyone's time. I know that everyone's busy too, so I think if we keep this thing going for too long, I think it's we did say we're going to keep it for an hour. I know we've run over time now. Conrad Zapata, I know you said you joined late. Will you be able to get a recording? yes, absolutely. Within the next day, we will be sending a mailer out to every single person who registered for the webinar, and you'll then be able to watch the live recording, and we'll also release shorter clips if you just want to catch one specific aspect of it. But again, to the panel, I really appreciate it. I think so many comments came through later about mentorship and insight, and this is exactly what we said. One discussion at a time, we can start changing the way in which people view property and the ability to create wealth. And like we've said, it doesn't have to be big investments. It can be smaller stuff that you grow in with time. And I think the input from everyone has been exceptional and really, really valuable. I'm sure every single person who's been on this chat and people who be in future will feel the same way. So like I said about the recording, we'll send that out. It gives you the ability, if you join late, to be able to catch up, and also send it to friends or family or people who you think might gain from the insight from the panel today. And yeah, we'll see you in 3 weeks' time for our next session. But hope you all stay safe and healthy, and hope you all have a great week further. Thanks very much.
Thank you.
Thank you very much.
Thanks to
Thank you,
everyone who watched.
Bye, guys.
Thank you,
Bye.
guys. Cheers.